Right now, billions of dollars are quietly walking out of the crypto market, and almost all of that money is heading toward the same place: artificial intelligence. This is Get Rich, and today we follow the money. In the final week of June, Bitcoin fell to its lowest level in more than 21 months, dropping close to $60,000. That capped a brutal month, with Bitcoin down around 20% in June alone, and sitting roughly 35 to 40% below the record high of about $126,000 it reached back in October of 2025. Across the wider market, altcoins followed it down. But here's the part that matters. According to reporting from Finbold and other outlets, a huge share of that decline was not caused by anything breaking inside crypto itself. No major exchange collapsed. No large stablecoin lost its peg. Instead, the exchange-traded funds that hold Bitcoin saw record outflows. About $4.5 billion pulled out in June, the largest monthly outflow since these funds launched, led overwhelmingly by BlackRock's own Bitcoin fund. In plain terms, big money was selling crypto, and a growing number of analysts say that money went looking for artificial intelligence. So today, we are investigating two questions. First, is the artificial intelligence boom actually a bubble? And second, if that money is flowing out of crypto and into AI right now, what does that really tell us about where it goes next? Because the loudest voices online will give you a simple answer and a coin to buy. The honest answer is more complicated and more useful. Let's start with the case for the bubble, because it is stronger than the hype crowd admits. The concern centers on something analysts call circular financing. Here is how it works. In the autumn of 2025, the chipmaker Nvidia agreed to invest up to $100 billion into OpenAI, the company behind ChatGPT. In return, OpenAI committed to buying and deploying huge quantities of Nvidia's chips. Around the same time, OpenAI signed a separate cloud computing deal with Oracle, reportedly worth about $300 billion. And to fulfill that deal, Oracle has to buy billions of dollars worth of chips, primarily from Nvidia. Follow the loop. Money leaves Nvidia, travels through OpenAI, travels through Oracle, and lands right back at Nvidia in the form of chip sales. The same underlying dollars can be counted as revenue, as funding, and as backlog by different companies along the way. Critics, including analysts at Bloomberg and the Register, have compared this to the vendor financing that inflated the dot-com bubble in the late 1990s, when companies bought each other's products to make growth look larger than real demand justified, and the scale is staggering. When you add up OpenAI's combined commitments for chips and cloud capacity across Nvidia, Oracle, and others, the total could exceed $1 trillion. Yet OpenAI is reportedly on track to lose around $14 billion in 2026, nearly triple its losses from the year before. Every dollar of growth inside that loop depends on every other company in the loop staying healthy. If one stumbles, the concern is that all of them feel it at once. Then there are the numbers from the skeptics. A report from JPMorgan calculated that the artificial intelligence industry would need to generate about $650 billion in brand new revenue every single year just to earn a basic 10% return on the more than $5 trillion expected to be spent on data centers and AI through the end of the decade. To put that in perspective, the bank said that is the equivalent of every iPhone user on Earth paying an extra $35 a month, forever. And then there is Michael Burry, the investor made famous by the film The Big Short for predicting the 2008 housing crash. In late 2025, Burry argued that the big technology companies are making their profits look larger than they really are by stretching out how long they claim their chips will last. Nvidia releases new chips on roughly a yearly cycle, which means older chips lose value fast. But many of these companies are treating those chips as though they will stay useful for 5 or 6 years. By Burry's math, that accounting choice hides around $176 billion of expenses across the industry between 2026 and 2028, inflating reported profits along the way. Now, here is where a real investigation has to be fair, because there is a serious counter-argument. Nvidia did not stay quiet. The company issued a detailed memo to Wall Street analysts rejecting Burry's claim, insisting its business is economically sound, its reporting is transparent, and that comparing it to accounting frauds like Enron or WorldCom is simply wrong. Industry leaders, including the chief executive of Anthropic, have defended the interconnected deals as a rational way to finance a genuine technological revolution, where one company has the capital and the chips, and the other has confident future demand but not the cash on hand today. And there is a structural point worth understanding. In any heavy build-out, the spending comes first and the revenue comes later. Peak spending is not proof of failure. It can simply be the most expensive stage of building something real. The market itself is caught between these views. Since Burry disclosed his bets against the sector, Nvidia shares have fallen around 14%, Palantir around 24%, and the AI cloud company CoreWeave roughly 40%. So the fear is real, and it is showing up in prices. But none of those companies has collapsed, and demand for computing power, by most accounts, remains enormous. That is the honest picture. This is both a genuine boom and a genuine risk at the same time. And anyone who tells you they know exactly when or whether it breaks is guessing. So let's return to crypto, and to the thesis that the hype channels are selling hard right now. Their argument goes like this. The money only left crypto temporarily to chase AI. It will come flooding back, and the entire AI economy will eventually be forced to run on crypto rails, so you should buy now while it is cheap. Let's separate what is verified from what is a bet. What is verified is that the rotation explanation is real. Crypto is one of the most liquid assets on the planet. It trades 24 hours a day, 7 days a week, including weekends. So when big investors need to raise cash quickly, for example, to buy into a wave of hot AI deals, crypto is one of the easiest things to sell. That mechanism is genuine, and it is part of why crypto fell while AI stocks stayed hot. What is also verified is that major financial institutions are, in fact, building payment systems that involve crypto. On June 10th of 2026, Mastercard launched a platform called Agent Pay for Machines. It is designed to let artificial intelligence agents pay each other automatically, without a human in the loop, for tiny transactions that happen continuously in the background. And Mastercard did not build it on the banking system alone. It built it to settle across cards, bank accounts, and regulated stablecoin, with more than 30 partners at launch, including major crypto names like Coinbase, Ripple, and the Solana Foundation. That is a real signal that the financial industry sees a future where machine payments may run partly on blockchain rails. But here is the nuance the hype leaves out. Mastercard's system is deliberately multi-rail. It uses traditional cards and bank accounts too, not only crypto. Mastercard's own product chief has said he does not expect meaningful revenue from it in the near term. And it is one company's early bet, not a finished transformation. So it is fair to call it a promising signal. It is not fair to call it a guarantee that everything is about to run on any particular coin. And that is the line this channel will not cross for you. Noticing that big institutions are experimenting with stablecoin settlement is analysis. Telling you that therefore a specific token is going to make you rich is not analysis. It is a sales pitch, and it is usually attached to a paid course or a phone call. So what is the actual lesson here? For that, look back at the dot-com crash. When that bubble burst in the year 2000, it did not kill the internet. It wiped out the overpriced companies with no real customers. Even the eventual champions, Amazon, Google, Microsoft, saw their stock prices fall by 80 to 90% on the way down. But the businesses with real users and real revenue underneath them survived, and eventually came back stronger. That is the test that matters, and it applies to both sides of this story. Not, is it AI or is it crypto? The real question is, which assets have actual usage and actual revenue holding them up when the hype money drains away? That is the framework the survivors of every bubble had to pass. It is a way of thinking, not a shopping list. One last thing, and it matters. Everything in this report is for information and education only. It is not financial advice, and it is not a recommendation to buy or sell anything. If this breakdown helped you see past the hype, do us a favor, hit that like button, subscribe to Get Rich, and turn on notifications so you never miss an investigation. And tell us in the comments, do you think the AI boom is a bubble or the real thing? We read them. Until next time, this is Get Rich.